Hello and welcome to the Rogue Agent Answers. My name is David Lewis, aka the Rogue Agent. I am doing a series of Q&A that was born out of people sending me questions. I would either get these via email, sometimes they would just come as people were talking to me on the phone, or if I was out there in the world and people were just happened to strike up a conversation, somebody happened to ask me something about it, or just stuff that got sent to me otherwise, just from across the interwebs, and just interactions that I've had with people in real life over the past 20 plus years. Anyway, the point of this whole series is just to finally just answer questions instead of, I used to just answer people's questions one off and just, like, hey, this is how this works, whatever. And I decided just to keep collecting these questions, write them down, and I'll bet that, and say that I just thought one day, like, I bet that more than one person has the same question. So this is why I'm doing this series of questions and answers. Anyway, I hope that you are able to get at least a little teeny tiny bit of value out of these answers, and maybe you'll hear your question answered on the show. So let's get into it. So the first question I have here, should I buy whole life insurance or term? I had to answer this one first because this is like one of the most frequently asked questions I've gotten over the past 20 years. And the short and sweet answer is if you can afford to buy whole life insurance and you're in the market for life insurance. First of all, let me preface that. If you're in the market for life insurance and you can afford the premiums for whole life, that is the policy to buy. Period. End of story. There's a lot of debate, a lot of stuff on the internet. You'll search for whole life insurance. You'll read a lot of negative stuff. Here's like the short and sweet of it. Okay. Whole life insurance is the gold standard for life insurance. The gold standard. It is the standard by which all other life insurance policies are measured. Whole life insurance has a high guaranteed premium purposefully so that the policy stays in force for your whole life. People tend to view life insurance as like this thing that, I need it when I'm young, but when I get old, I don't need it. So whole life insurance covers a range of financial risks. Okay. It's not just, a big part of it is death benefit, but there's more to it than just death benefit. There's, risk of death, which is the obvious one for life insurance. There's also a whole bunch of risks associated on the savings side that a whole life policy deals with very nicely and very simply by providing cash surrender values, an equity value, which they call the cash surrender value. Some people call it the savings component of the policy, that provides zero volatility, no volatility whatsoever. And that takes an incredible amount of risk right off the table in just about any financial plan. Forget about rate of return for just a second, and just think about when you get a savings or whatever that's not subject to any volatility, it will never go down, ever. You're completely protected from any sort of downside. That's the major benefit from the cash value portion of the life insurance policy, of the whole life policy. Now, every other life insurance policy is a stripped down version of whole life. So if you're moving down, if you go from whole life to term insurance, you've basically stripped it down so there's no cash value in the policy anymore. And what you're left with is death benefit. But you're not really left with a death benefit that you can keep forever, because the insurance company is the guaranteed premium on the term policy is not high enough to keep the policy in force forever for your whole life. It's only high enough to keep it in force for just a short number of years. Sometimes 1 year, sometimes 5 years, sometimes 10, 15, 20. The longer you keep the policy in force, the higher the guaranteed premium is. So with term, the idea is that you're going to have a guaranteed level premium that's just high enough to keep it in force for a specific number of years, and then it's just going to lapse. It's just going to drop off and the policy will terminate, or it will renew at 10, 15, 20, 30, 50 times what your level guaranteed premium used to be. So you have a choice at that point. Most people don't want to keep it. Some people have to keep it because they're not insurable anymore and they want the insurance or they need it for some reason. And then their premiums jump way up. They can't buy insurance, so they're stuck paying higher premiums, much higher premiums. So forget about for a moment whether you think you will need it in the future or not. I don't know that anybody really knows for a fact that they quote unquote need life insurance. Life insurance is always and everywhere a question of value. It's a question of what you want. It's a question of your values, not a question of whether you need something, or rather whether you value the policy, whether you value the coverage, whether you want to. If you have kids, that's a more obvious sort of scenario. You have something to protect. If you're married, you value your spouse and you want to protect their standard of living. And life insurance is a very simple way to do that. Again, I'm not saying it's a need. It's more about value. Do you value your spouse and their standard of living? Do you want them to maintain it? And you want to do it in a safe, guaranteed, simple, and guaranteed way. And then the third thing is whether you're married or not, over and above that, any charitable causes that you believe in that you want to fund after you die, but that you don't want to use all of your savings for. Life insurance is a way to leverage that. So you can take a portion of your savings and buy a multiple of that in death benefits. So you could maybe take $250,000 and turn it into $500,000 or $750,000 or $1 million. And instead of giving $1 million to charity, you can give $250,000 to charity and still give them $1 million in death benefit. So effectively a way to leverage your personal savings or investments. So in order to really do that, whole life insurance is the product that you need, quote unquote, need to have for that. Term insurance is a stripped down version of whole life. You don't get, you basically strip away almost all of the benefits and you're left with a small guaranteed premium and a very relatively short guaranteed death benefit. Universal life is sort of a mix between the two. So you're going to get universal life is really a 1-year renewable term that is mated with a cash value account. So premiums go into the cash value account. Insurance company deducts cost of insurance every month, and then whatever's left over gets credited back with interest. And the thing with universal life is that it's sort of in a way, it's a hybrid product. It's sort of halfway between term and whole life. It's not going to do either one really well. It's more of like, it's you could kind of think of it as more like a select a term kind of product where you can put enough premium in to get enough death benefit, to get a long enough death benefit, or get a death benefit that matches the number of years you want it to have it for, and then just fund the policy accordingly. So in other words, you could say, if you want a death benefit that lasts 27 years, you can put in enough premium into a universal life policy to keep the death benefit in force for 27 years and then stop paying premiums. The cash value drains out of it and your policy lapses, and that's it. It did exactly what it was supposed to. It'll last typically longer than what a traditional term would, and you might be able to actually get away with paying less premium depending on the policy and how you fund it and so on. You might be able to get away with paying less overall, especially if it's like a long dated or a longer dated universal life policy. You might be able to get away with paying less premium than you would on an equivalent term policy. And sometimes you can get cash value back, depending on the policy. So what some people, especially with now in the indexed universal life, which is very popular today, people will sort of overfund their index life insurance and try to turn it into a whole life product. It's still a term policy made it to a cash value account. It functions the same. It's all non-guaranteed. It's all based on current assumptions. The mortality charges are variable. Crediting rates are variable. So it's sort of halfway between term and whole life, and it's not going to do this. It's not going to do either one really well. It's supposed to kind of look like, if you heavily fund it, it's going to look like whole life, but it's not going to be a whole life product. If you what they call thin fund it on the lower side of kind of what is acceptable on the policy, then it will be priced more like and act more like a term policy. But really, your choices are essentially between whole life and term. And again, with universal life is still a term product. It's like a 1-year term with a cash value account. So it's a form of term. So basically buy term and invest in difference. So you're really choosing between some kind of term and versus a whole life product. If you have the money and you are in the market for insurance and you really understand kind of the point of the insurance, which is, at least in some people call it heretical viewpoint, life insurance is about hedging risk. You plan for the worst and hope for the best. And under that sort of assumption where you're trying to hedge financial risks, you're trying to take risk off the table, not introduce new risks. Whole life insurance does that better than other types of life insurance. Okay, that wraps up our very first episode of the Rogue Agent Answers. I hope that you found this helpful or valuable in some way. And I will see you in the next episode.